welcome back to the ConchEconomist, and today it is my distinct privilege to interview a mortgage expert. We are going to find out all about mortgages, and this is going to be real helpful to those of you who are looking for your first home this year to buy in 2026. My guest is Joanne Zero.
Been a mortgage broker for 28 years, and I started my own company, and that's all I can tell you. We do all types of financing, which we're going to get into today, and that's Arrow Mortgage. We're located in Florida. We finance mainly in Florida.
Okay, you work all over the state, but Joanne. We're going to do this in two parts today. And the first part, we're going to be talking about actually getting the mortgage and the property and the borrower, and then in part two, we'll get into some of the cost and details. But this is a good point, because if there's
all purchases require an appraisal, and even any mortgage requires, most mortgages, I should say, require an appraisal. If you are purchasing a property, the appraisal is ordered, and it has to appraise at the cost of what you're buying the home for, the price.
What if there's a difference?
And if it doesn't, then that's where negotiations come in.
Okay.
You'll go back to the seller and you'll negotiate. Hey, the house didn't appraise. It appraised for $5,000 under what our asking price is, our contract price. And then there has to be some negotiations. You can either negotiate and get the seller to decrease the cost. Sometimes the seller and the buyer will split the cost. If it's off by $5,000, well, then we'll lower the purchase price by $2,500, and the buyer would have to bring an additional $2,500 to close. The third option, you might have a seller who will not go down on their price.
Right.
So at that point, you either decide, okay, I'll move forward and I'll pay the difference, or I'm going to walk away from the property.
That can happen.
And that
Now,
does.
is there anything else that influences a lender's decision to loan besides the appraisal?
Oh, if the appraiser sees some leakage in the ceiling inside the house, well, then they're going to call for a separate inspection. They're going to want a roof inspection. They're going to want someone to come out and make sure that the roof is taken care of,
Okay.
that it's okay and
All
it's
right.
lendable.
All right.
So yeah, a house has to be in a certain shape. You just can't be, you can't have, cabinets missing and toilets missing. It has to.
The property has to qualify.
It has to qualify.
Okay. Well, let's talk about the borrower now. This is a bigger concern, because there are so many things that go into this. And why don't you just identify a few here that influence what the lender is going to require from the borrower?
The first thing, before you even look for a house, you really should get pre-qualified. You should call a lender, mortgage broker, and say, I want to get qualified. And then at that point, they are going to review your situation with you. They're going to talk about your income, how your job stability, how much money you have. They're most likely going to pull your credit at that time, because they need to have a big picture of your financial situation, your credit history, to know if you will be worthy of being lent money. And depending on your qualifications and your income and your debt, that will determine what you qualify for.
Let's talk about credit report. What can people do to improve their credit?
Well, obviously, no late payments. You do not want to have any late payments, because that will bring your credit score down very quickly. Obviously, no bankruptcies, foreclosures. If you do have that, you still can get financing, but it's going to be different. There's time frames that you have to adhere to. So credit, another thing you don't want to do that most people don't realize is you don't want to have maxed out credit cards. If your limit on a certain credit card is $2,000, you don't want to have a balance of $1,900 when you're pulling the credit report,
Right.
Because it's going to appear that you have maxed out credit cards, and that, with the algorithms, that doesn't appeal to high credit scores. It's going to ding your credit scores. So you want to be conscious of that. When you are going to have your credit pulled, have your balances be at 35% or less. That's going to get you the best credit scores.
Okay.
Obviously, no late payments. And
when the lender is looking at your income and what you can afford, what are they taking into consideration? Of course, they're taking into consideration
Property taxes,
and taxes.
insurance,
Okay.
if there's any HOA
Any
fees.
HOA fees?
You
Okay.
could have flood insurance.
All right.
That's another thing. So really, it's the principal, interest, tax, insurance, any HOA fees,
Or condo fees.
or condo fees. Yes.
So, right. Now, would the lender also take into consideration other payments that you have?
Yep, they're going to take into consideration any debt that you have: student loans, car payment, credit card debt, boat loans, any installment or revolving debt that you have that you pay monthly.
So, this is not the time to buy the boat. This is not the time to buy a new car. Wait until you get the house, then you buy the boat, and then you buy the car.
And wait until you close on the house.
And wait till you close
because
on that.
I might get you pre-qualified and your loan is approved. And if you go and buy a new car or open up a significant debt, you might not qualify with that. So you never want to make any purchases, even appliances. Oh my God, I'm closing in a week. I want to buy a new refrigerator. No, don't do that. Close first and then
Then
purchase.
you buy the toys. Then nationwide right now, the typical balance on a new car loan, I'm talking about new car loan, $45,000. Wow. And the vast majority of the monthly payments are like $750.
Yes. Yeah.
You can pay a lot of mortgage for $750.
You can.
Ballpark. What do you think? I have a choice of either $750 on a car payment or $750 on a mortgage.
Oh, that's a $120,000, $130,000 loan, depending on the interest.
The same amount of money will only support, say, $45,000 of car loan, but it would support a $120,000 house. A big difference.
Yeah.
So
there's many different programs out there. You talked about credit.
All right.
So we'll kind of do a brief summary of an FHA loan maybe versus a conventional loan.
Good.
FHA is a more lenient financing. They're going to give you a loan even if your credit score is 600. Where conventional, for the best rates in a conventional loan, you want to be at least a 680 or above. You can do it at a 640 or 660, but when you have those lower credit scores, you're going to find out that an FHA loan is financially better for you than a conventional loan.
Okay.
FHA is a little easier as far as a debt to income ratio. So when you're getting approved for a mortgage, they're looking at what your income is versus what your debt is. And when I say debt, it's the new housing payment, and that's your front end, like your housing ratio. But then they're going to look at your total expense ratio, which is the house payment and all the other debt that you have. Mm-hmm. And with FHA, they will allow you to have a little higher debt to income ratio than a conventional loan does. So for someone who has credit 700, 680 and above, you probably will want to go with a conventional loan unless you are very tight on money. And that's another thing we can talk about is, so as far as credit, you have FHA, conventional, there's numerous other ones, but we're just going to talk about those two. And so interest rates on FHA are very good. They're actually sometimes lower than conventional. But the downside with FHA is mortgage insurance. So there's so much to talk about. So with mortgage insurance, anytime you're purchasing a home and you don't have at least 20% to put down, this is for conventional, you're going to have mortgage insurance that you're going to have, private mortgage insurance, which is known as PMI.
All right.
If you can put 20% down, you avoid that. If you can only put 5% down, then unfortunately you're going to have mortgage insurance. With FHA, you have to pay an upfront mortgage insurance premium that gets added to your loan amount, and you are going to have mortgage insurance even if you put 20% down, because FHA requires monthly mortgage insurance. Mm-hmm. So FHA, it's 0.55% of your loan amount, where conventional really depends on the loan to value you're at. You're going to get cheaper mortgage insurance if you're putting down 15% versus 5% or 3%. You can do conventional 3%. So it's going to be cheaper the more money. FHA is always 3.5% down. You can get a conventional loan with only 3% down.
Really? Okay.
You have to meet the guidelines, but yes, you can get it with 3% down.
Okay.
And so mortgage insurance is also depends on, for conventional, it depends on your credit score. And again, the lower the credit score, the more the mortgage insurance will cost monthly.
All right, this is an important point.
Get your credit
Get
score
your
up
credit
as
sure
high as
up so
possible. You have the lowest interest
rate to go
rates.
down.
Yes.
Right.
There's a lot of things with income. If you're a W-2 employee and you've been in that job for 2 years, that's the income we will use, your salary position. If you are 1099, that's going to take a 2-year average on your tax return. So I'm going to have to see the past 2 years, and let's look at what the income has been for the last 2 years, and we take an average of that for the most part.
That was for people who are self-employed and so forth.
Self-employed, yes. Okay. People who are self-employed, because a lot of them write off. There's a lot of expenses when you're self-employed, and so you write off a lot, and then that brings your income down.
Got it.
So your history, if you have work, experience in the same line of work, that can come into play. Now, let's say somebody who makes a lot of tips, servers, bartenders. If you don't claim the tips on your tax returns and you're not paying taxes on them, well, then that's not going to be income.
You need a paper trail.
You need a paper trail. Yes, very much so. The most important thing I will say is when you're thinking about buying a home, I'd like to buy a home instead of rent, because you can buy a nice house for the money that most people are paying in rent nowadays. So the most important thing, just call a mortgage broker. Before you even call a realtor, call a mortgage broker and let them walk you through all this, because there's too much to even discuss, in 1.5-hour session. There's a lot of different factors that you have to analyze and you have to look. And if you're interested in buying a home, call a mortgage broker, get pre-approved. Let's talk about all those issues.
All right.
I work with people, I tell them what to do, and then they'll call me back in 3 weeks, a month, 2 months, and they'll be like, I did X, Y, and Z. We can get the credit scores up. There's a lot that we can do to help out.
Sounds great.
Call a mortgage broker.
You. And don't forget to watch us now on part 2, where we'll get into some of the details on the note and mortgage.